One of the tax benefits associated with the ownership of commercial and residential multifamily real estate is the ability to take depreciation expense against the cost of the improvements. In this short video, you will learn the fundamentals of cost segregation, a time-tested tax strategy that accelerates depreciation expense. My name is Jeff Glass, and I'm going to share with you some information about income tax reduction for commercial real estate owners using a tax strategy known as cost segregation. As a business development representative with Bedford Cost Segregation, I work with property owners and their advisors all over the country, primarily in my home state of California. Let me briefly introduce our firm. Bedford Cost Segregation was formed in 2002, and today it is one of the largest cost segregation firms in the U.S., with 16 professional engineers and a staff of approximately 60 people. Bedford provides its services nationwide, and since its inception has completed over 10,500 studies, saving owners hundreds of millions of dollars in income taxes. Our firm was a founding member of our industry association and has led the industry in the establishment of quality standards for cost segregation studies. Bedford provides a written warranty with each study, assuring clients that in the event of an IRS audit, Bedford will defend its work at no charge to the client. So what is cost segregation? In brief, it's the IRS-accepted technique of calculating the component costs of property consisting of multiple asset types with different recovery periods. A simpler definition is that it's the IRS-accepted method of taking accelerated depreciation on commercial real estate. Now, why does cost segregation exist? First of all, recall that when a tangible asset, including real estate, is acquired, it is set up on a depreciation schedule for accounting and income tax purposes. Depreciable real estate typically has a 39-year depreciation life, unless it's residential, in which case it has a 27.5-year life. That's the usual method taken by the majority of property owners and their tax advisors. However, the IRS allows shorter depreciation lives for some types of assets. Shorter depreciation lives, to the extent that they can be used, reduce income and improve cash flow. However, you cannot automatically take a shorter depreciation period on real estate. The IRS expects property owners claiming shorter depreciation lives for certain assets to provide documentation in the event of a tax audit. Now remember, depreciation is not a cash expense. It's an accounting convention that allows for cost recovery because tangible assets other than land tend to wear out or become obsolete. As such, depreciation expense affects taxable income and taxes, and that's why it's important to the ultimate cash flow available from real estate investments. Depreciation lives permitted by the IRS vary according to the type of asset. Land, of course, is not depreciable at all because it doesn't wear out. However, real property does, and it's considered to have a 39-year life by the IRS, unless it's residential, and as I said, that has a 27.5-year life for tax purposes. Now, it's important to know that the IRS recognizes different types of assets, including two very important ones for cost segregation purposes, one being land improvements, which are considered to have a 15-year life under the tax law, and tangible personal property, which is considered to have a 5-year depreciation life. The opportunity to take accelerated depreciation becomes apparent when we recognize that commercial real estate and multifamily residential real estate actually contain all of these types of property: real property, land improvements, and personal property. At Bedford, based on our many years of experience, we've learned what the typical ranges are for these mixes of property. For example, looking at the second line of this table, we can see that a garden-style apartment typically would have a range of 20% to 40% of its overall costs assignable to shorter depreciation periods than the typical 27.5-year period for the entire set of improvements. Near the bottom of the table, you can see that an office building would have anywhere from 8% to 30% of its property potentially reassigned to a shorter depreciation period than the usual 39-year period. The idea of separating real estate assets into these different recovery periods for tax purposes began with a precedent-setting court case. Back in 1997, Hospital Corporation of America, which owned many large hospitals, was challenged by the IRS for taking faster deductions than the IRS felt was warranted on many of the items of property contained within their hospital facilities. Here I have listed many of the items that HCA claimed as short-term property. In order to prepare for their case, HCA hired construction engineering consultants to help them determine what might be defensible as short-term property. As it happened, HCA won its case, and this established a precedent for segregating assets within and around buildings according to their characteristics and functions. During the first few years after that case was settled, the beginnings of today's cost segregation industry began to form. At first, services were offered by the top-tier accounting firms and were provided initially to the top-tier clients with large buildings. Each project was highly customized, and efficient methods for performing the studies had not yet been developed. Therefore, cost segregation studies were quite costly to perform, and the fees were relatively high, limiting the use of cost segregation to mega properties where the high fees could readily be justified by the enormous tax benefits. Over the years, cost segregation went mainstream. Bedford entered the field in 2002 as a standalone service and soon created sufficient volume to drive down the cost of producing the service, thereby enabling a substantial reduction in fees. At the same time, the IRS was influencing the conduct of cost segregation studies by publishing its quality standards in the form of a detailed guide for use by IRS auditors. Concurrently, industry standards began to form in 2006 when Bedford's managing director teamed with members of competing firms to establish the American Society of Cost Segregation Professionals. This is a standards body that was instituted to educate industry participants in the areas of technical and tax matters. Today, cost segregation is mainstream and is considered widely applicable to the general market with greatly reduced fees and a proven record of success for clients. It should be noted that the IRS has certain expectations for the quality of cost segregation studies, including who is qualified to perform them. Within the IRS Audit Techniques Guide, the IRS has published instructions on what auditors should look for with regard to the preparers of cost segregation studies. Auditors are expected to confirm that studies have been prepared by individuals and firms possessing appropriate background and qualifications, including looking into their construction engineering experience and cost estimation skills. Even though cost segregation studies are seldom brought within the scope of IRS audits, in the event a study is reviewed, the taxpayer can expect close scrutiny of not only the results of the report, but its methodology and the qualifications of the authors of the study. For this reason, property owners seeking cost segregation benefits should seek out the best available providers that adhere to both IRS and industry standards. So what is a cost segregation study? If you were holding a printed cost segregation report in your hand, at first glance you might think that it was an appraisal report full of property details and photos of the property. But cost segregation studies are not appraisals. They are, in essence, a cost breakdown. Skilled engineers determine how much of the overall cost of the improvements can be reallocated from a long depreciation life to one or more shorter depreciation lives. To do this, they use documentation provided by the property owner if available, such as plans, specifications, cost records, surveys, and appraisals. The engineers also will visit the property and will conduct a detailed physical inspection inside and out. All of the records and observations will be used to produce a final report that provides, in both summary and detailed forms, a listing of all of the assets comprising the improvements and how they break down into various depreciation categories. All of this is done in conformance with the above-mentioned standards. I'd like to illustrate how the engineers determine what goes into the 5-year personal property when they're looking at a commercial or multifamily residential building. In this instance, we're looking at the interior of a grocery store, so it's a very familiar setting, and I'd like to point out some of the things that our engineers would discover to be 5-year personal property. We'll begin with the intercom system located on the ceiling. Then there's the neon sign in the background, the various equipment and electrical systems necessary to protect the produce, the floor drain, and the flooring itself, which is probably linoleum or some sort of resilient flooring. All of these items would be considered 5-year personal property by the IRS, and the job of the cost segregation provider is to identify them, quantify them, and cost them out in a way that reconciles to the overall cost of the improvements. Most of the improvements located outside the walls of a building are normally considered 15-year land improvements. In this image, we can see items commonly found in a parking area, such as asphalt paving, concrete curbing and gutters, landscaping and irrigation systems, a concrete masonry wall with decorative tile inlay, and an iron gate. It's usually the case that assets such as these are embedded within a 39-year building asset on the owner's depreciation schedule. In this common situation, segregating their costs and applying a 15-year life to them will improve the owner's cash flow. This excerpt from an actual cost segregation study shows the high level of detailed asset classification that can result when a study is performed. In this example, we can see items listed such as wiring, cabinetry, solid surface countertops, vinyl base surrounding the flooring, and the flooring material itself. All of these individual assets are extracted through a reverse engineering process and costed out by cost segregation engineers to determine what can be considered short-term property and how much cost to allocate to them. The ultimate result of a cost segregation study is illustrated in this pie chart, displaying a reallocation of the original aggregated asset into several slices representing asset groups with different depreciation lives. In this case, the original allocation was 100% to 39 years. After cost segregation, 14.9% has been reassigned to a 5-year personal property classification, 10.5% to 15-year land improvements, and 0.68% to 15-year leasehold improvements. The property owner's accountant can use the dollar amounts behind this chart to adjust the depreciation expense going forward in accordance with the new depreciation lives for each asset class, resulting in faster overall depreciation and reduced income taxes. To better understand what this means, let's take a look at a situation where a property planned for acquisition would normally be depreciated over 39 years in total. The red line in the graph illustrates the straight line depreciation that would occur, with a jump up and a step down in the first and last years caused by a mid-year purchase date. If cost segregation is applied to the property immediately after acquisition, much of the depreciation expense will shift from later years to earlier years, as represented by the blue line. The increase in depreciation expense during the first few years is caused by two factors. First, personal property and land improvements will be assigned shorter depreciation lives. Additionally, those types of assets are eligible for accelerated depreciation instead of straight-line depreciation, which is required for real property. 5-year personal property is allowed to be depreciated using the double declining balance method, and 15-year land improvements may use the 150% declining balance method. So the shift in depreciation expense is magnified by the combination of these two factors. Notice that no new depreciation expense is created by cost segregation. Instead, costs are being reallocated to shorter depreciation lives, and depreciation expense becomes front-loaded. This results in additional after-tax cash flow during the early years of ownership, assuming the owner's income is sufficient to use the additional deductions. The increase in after-tax cash flow is represented by the green line during the first 15 years in the graph. In this illustration, at around the end of the 15th year, depreciation expense and after-tax cash flow become less than what they would have been if cost segregation had not been applied. The value of this tax strategy is based on the time value of money. By analogy, when a person wins the lottery, they will usually prefer the option of receiving a discounted lump sum payment up front rather than receive a series of smaller payments over many years. Similarly, with cost segregation, many property owners perceive a significant benefit to reducing their income tax via accelerated depreciation in the early years of ownership because they can use the additional cash for productive purposes rather than let the government hold the money. The amount of tax savings that a property owner can reap from applying cost segregation depends upon a variety of factors, starting with the property owner's tax bracket and their ability to use additional deductions. The outcome of cost segregation will also depend in part on how long the property has been in service, the specific types of property under study, and the improvements therein, including the types of materials used. A number of other circumstances can affect the outcome, including whether the property was part of a tax-deferred exchange and whether any of the tenants in rented or leased building spaces happen to be tax-exempt clients. These complexities can be addressed through consultation with your tax advisor and your cost segregation specialist in order to determine whether cost segregation is an appropriate tax strategy. Cost segregation can be applied to virtually any type of depreciable real estate, from residential to the many forms of commercial property. This includes office, industrial, hotels, restaurants, shopping centers, and even specialty properties such as car washes, golf courses, and theaters. Cost segregation can be applied cost effectively to properties ranging in cost from as little as $1 million in depreciable basis, such as this freestanding beauty salon on the left, to luxury condos costing $2 million, and mega properties such as a large office campus costing hundreds of millions. Ideally, cost segregation is applied as soon as a building is constructed or acquired and ready to go into service. In such cases, there's no waiting to receive the tax benefits. However, cost segregation can be a rewarding tax strategy for buildings that have been owned for some years and already have had a significant amount of depreciation expense taken in the past. Buildings with $5 million or more in initial cost basis can often make excellent use of cost segregation even after 10 to 15 years have elapsed since acquisition. Even after 15 years, with a 39-year depreciation schedule, there will still be a large amount of potential accelerated depreciation waiting to be taken on a retroactive basis if the property contains significant amounts of 5-year and 15-year property. In addition to complete buildings, cost segregation may also be applied to tenant improvements. Typically, if a tenant has put in at least $300,000 to $400,000 in tenant improvements, there's a good case to be made for cost segregating those assets because a high percentage of them will likely be classified as personal property. Restaurants, doctor or dentist offices are good examples, where expensive interior leasehold improvements are often made. It's not unusual to find that 40 to 50% of tenant improvements can be classified as 5-year personal property. Now I'd like to show you 3 examples of cost segregation to illustrate the level of tax benefits that are possible. First, let's look at a commercial building. In this case, a shopping center was acquired for $15.5 million. $5.5 million of land costs left $10 million in depreciable improvements. A cost segregation study revealed that 35% of those costs could be reallocated into either 5-year or 15-year property. The resulting tax benefit in the first year was $110,000, and the 10-year net present value of the tax benefits over the first 5 years was approximately $632,000. In this next example, a high-rise apartment building with significant land improvements was acquired for $29 million, with about $20 million of that represented by depreciable assets. Of that, approximately 29% was reallocated to 5 or 15-year. The first tax year benefit was $302,000, 10-year net present value over $1.2 million. As with the first example, these results reflect application of cost segregation immediately after acquisition. The third example is a little different because cost segregation was applied on a retrospective basis in the 8th year after acquisition. This approach is allowed by the IRS without the need to amend past tax returns. So in this example, we had a building with $41.5 million in improvements after deducting the cost of land, and 24% of that cost was reallocated into 5 and 15-year, producing a first-year tax benefit representing all the benefits they could have taken over the past 8 years of $2.5 million in tax benefit. The timing of the receipt of tax benefits has been delayed by not performing a cost segregation study upon acquisition, but still produces a large, although delayed, tax benefit. When should cost segregation be considered? Let's take a look at the most common situations that can trigger the opportunity to benefit. As discussed earlier, when a property is ready to go into service, either due to completion of construction or the acquisition of a property, cost segregation should be considered. Similarly, when a building is acquired by a tax-deferred exchange, if there is additional basis above the exchange basis required to acquire the property, that additional basis may be subjected to cost segregation. Renovations and property expansion costing $1 million or more can result in the addition of assets that may be good candidates for cost segregation, especially if the costs include interior finishes or other non-structural assets. As mentioned previously, if a tenant with leasehold interest in a property adds at least several $100,000 worth of tenant improvement costs, there may be a good case to be made for cost segregation because, again, those types of improvements tend to include a high proportion of assets that the IRS considers personal property. Another common trigger for cost segregation benefits is a step-up in basis. These often occur due to the buyout of a partner, death of a partner, or inheritance. When these events occur, a new asset is added to the depreciation schedule in an amount reflecting the fair market value of the ownership interest that is received. If that new asset has a cost of $1 million or more, it may be a good idea to cost segregate the property and apply the results to the stepped up asset. There are several additional applications of cost segregation studies for tax savings. One would be missed bonus depreciation or qualified leasehold improvements. It's often the case that these types of deductions are missed during the preparation of tax returns. When a look-back study is performed, it is not uncommon for the cost segregation firm to identify missed deductions from prior years and list them in the study as a value-added finding. Another area would be writing off existing assets that have worn out or been made obsolete and must be replaced. Until recently, there was no tax accounting mechanism to write off the remaining cost basis for such items. Under the relatively new IRS repair and capitalization regulations, it is now possible to remove from the books building assets which have been removed. However, it is necessary to determine their original cost. Since those costs may have been buried within the acquisition cost of the property, a cost segregation study may be the only way to obtain defensible cost figures that could be used to take the write-offs. In addition, under these same new regulations, the definition of capital items has been revised so that many costs that had to be capitalized and depreciated in prior years now may be retroactively reclassified as repair and maintenance expenses. A cost segregation study can help obtain those tax benefits, which can be substantial because there is no limit on how many years back a property owner may go to reclassify past assets as expenses. Finally, planning future dispositions are a good idea, of course, and if a property owner expects to renovate and possibly throw out some of the components of their building in order to make way for new ones, having a cost segregation study done in advance can provide the detailed information to write off the remaining tax basis of any of those old assets that are going to be abandoned and disposed. This concludes my presentation. The main idea I'd like to leave you with is that cost segregation can be a great tax reduction strategy for commercial real estate owners. Also, be aware that not all cost segregation providers are the same. If you're considering cost segregation, look for an experienced provider that adheres to the quality standards set forth by the IRS and the Cost Segregation Industry Association. A quality cost segregation study is important because it can protect the property owner from problems if the study is ever brought within the scope of an IRS audit. Thanks for watching. Hope you enjoyed the ride. For more information, please contact me, Jeff Glass, at Bedford Cost Segregation.